We're down now about a 50% Fibonacci retracement on that in silver. Now, gold is not doing that. Silver is crashing down. But remember, silver is the yappy dog. It moves more violently. We haven't seen gold move as much. It's still above the 200-day. It hasn't tested this first Fibonacci at 61.8%. It's not retracing. Gold is still strong. It's still in a bull market. It's a minor move.
Welcome to Gold Silver Pros.
Hey everybody, this is Rob Keens with goldsilverpros.com. This is your weekly market wrap-up for Friday, May 26, 2023. We're recording this about 12:45 p.m. Central Time, so keep that in mind when we go over prices. Today's been an interesting week. Let's dive in and look at what we see on the charts. First of all, going over gold, it's trading right now at $1,943.29. That's up $2.81. And gold and silver are both channel trading, which I'll show you in a chart here in a moment. Silver is up 52 cents to 23.23, both in the green for the day. They've had a decent week, although since the beginning of April, they're at about the same spot, about the mid-1900s. And like I said, we'll go over that as we get into it. Looking at the data for this week, a lot of data came out, to be honest with you. Looking at early this week, we had comments by the Fed. Mostly those are about what you saw in the press. We did have a nice print on the U.S. services PMI. That means the service economy, the biggest part of the economy, the purchasing manager index, meaning how much they're going to have to purchase to facilitate that. In other words, it's an indicator of how services is going. The economy is up. It's a strong 55.1, which is a positive signal, and it's higher than last month's 53.6. We've seen a little bit of a nice rebound in the services industry in the past month. The manufacturing PMI is actually positive. It's got a 51 print. Anything 50 or above, or 50 is considered even. Anything 50 above 50 would be considered positive. This is just slightly above 50, but it's nice to see. New home sales are actually up as well, 683,000 against 656,000 last week. And GDP on the second reading, or the reprint, if you will, for quarter one, is up slightly, 1.3% instead of 1.1. Now, if you inflation adjust that, it's negative. So are we in a recession? When adjusted for inflation, yes, we are in a recession, but the government won't call it a recession because they don't inflation adjust that GDP number. They're just going to give you the GDP number. So because we have any growth whatsoever, they're not going to call it a recession, even though wage growth is lower than inflation. And even though people's paychecks can't stretch further, that's my definition of recession. Officially, it's not the government, but that's okay. I think we're going into a recession this year. Most people agree to that. We'll see what happens. Overall, durable goods orders are down at 1.1%. That's a third of the increase they were last month at 3.3. Durable goods minus transportation is negative. So transportation durable goods, the transportation industry was net positive. The rest of durable goods was net negative, meaning not a lot of durable goods orders other than transportation this month. Personal spending was up 0.8%. Retail inventories was slightly up. So the economy and consumer sentiment is 59.2, which is slightly up. So overall, you can tell the consumer is feeling a little bit positive. We've had a nice little boost in services. Manufacturing is holding serve. It's not great, but it's holding serve. And the rest of the numbers are maybe a tad soft, but not horrible. So this past month actually hasn't been too bad in terms of what's going on in the economy. If we look over here at the cryptocurrency markets, they're up, but they're not where they were a couple months ago. We had that nice pop. Bitcoin is up $237 to 26,712. If we look at Ethereum, it's up $14.09 to 1823.92. Litecoin is up $2.09 to 87.09. And I'm looking at the rest of the crypto complex, and most of it is in the green, so it's doing okay. The bond market is still in yield curve inversion. I go over this every single week. When you have a yield curve inversion, it means your 2-year demands a higher interest rate than the 10-year, which means bond investors expect more trouble now, which is a recession indicator. It's been 100% accurate in the past when it's been measured. In the past 6 to 7 times we've had a recession, this indicator has gone negative. So it still appears as though we're headed for a recession. The big news of this week, the big story this week is the debt ceiling. It says here on CNBC, debt ceiling negotiators close to a deal with IRS funding in the spotlight. Okay, sounds pretty positive. Let's read through. The White House and congressional negotiators were closing in on a compromise agreement to raise the debt ceiling for 2 years. House Republicans are on track to win on some top priorities, including rescinding some of that $80 million that went to the IRS in last year's Inflation Reduction Act. If there's a deal Friday, a House vote to raise the debt limit could be held on Tuesday, with the Senate voting on Wednesday. So I think this could be closed as early as next week, although we're not 100% sure they're in agreement. The story says the White House and congressional negotiators were closing in on a compromise agreement on Friday to raise the debt ceiling for 2 years with just 6 days to go before the nation faces the grave threat of debt default. And I'm going to tell you how Fitch sees the potential debt default. They're issuing a warning, and they're a ratings agency. Wait until you see this. That's the big story of the week. But leading up to it, the markets did rise this morning. They're buoyed in part by optimism that the sides would reach a deal in time to meet the Treasury Department's June 1 deadline. Failure to lift the borrowing limit could damage the U.S. economy and jeopardize benefits millions rely on to survive. House Speaker Kevin McCarthy also appeared upbeat as he arrived in Capitol. He says, I thought we made progress last night. We've got to make more progress now, the California Republican told leaders. So now I'm going to share a screen and show you something that came out from Fitch. I believe Fitch is looking at this going, yeah, you're still in trouble anyway. So Fitch places the United States AAA rating on Rating Watch Negative. Now, they have not downgraded officially the nation's bond rating or the nation's credit rating, if you will, but they're putting it on negative watch, and the key ratings driver are the debt ceiling brinkmanship and why this is an issue. So they're looking at this debate and saying, well, this could be a negative, but also that the debt ceiling limit's been reached again, that the X date is approaching. That means the failure to reach a deal could suspend the debt limit and debt default rating implications. We believe that failing to make full and timely payments on debt securities is less likely than reaching the X date and is a very low probability event. Such a failure would be a debt default under Fitch's sovereign rating criteria and would lead us to downgrade the sovereign IDR to restricted default. Affected debt securities would be downgraded to a D. Additionally, other long-term debt securities with payments due within the following 30 days would be downgraded to a CCC, and Treasury bills maturing within the following 30 days would be downgraded to a C. That's potentially really bad, and Fitch is not playing around here, which makes me think that they're serious about what's going on with this debt ceiling drama. And is this a little bit of a push for the Congress to do something? Undoubtedly, because the news is going to be following this. We're also looking at what's happening to the lower end of the market. We seem to be in a bifurcated or a two-tier market. At the very top end, luxury houses, cars, goods are all doing very well because there are a lot of people who are well-heeled who haven't been as affected by inflation, supply chain issues, joblessness, things like that. On the other hand, you have the lower end of the scale sort of falling off the bottom. Article here, Dollar Tree plunges after profit tumbles as thieves pillage stores. Now think about this for a moment. Dollar Tree is about the cheapest place you can get stuff, give or take. In other words, you know, on the retail chain, it's at the bottom. And not only are they not having enough money to make ends meet at the Dollar Tree, which means poor people, you would think everybody would be flocking to Dollar Tree for toothbrushes and clothes and whatever you need, are not doing it. But also thieves are pillaging stores. These are people that are pillaging because they don't have enough money to buy. Think about all the people now that can't buy at Dollar Store that now have to rob from Dollar Store. We're not talking about robbing BMW or robbing a Tesla, okay, or robbing a high-end, really nice, you know, item from a nice French patisserie. You know, you're talking about robbing Dollar Store. We're talking at the bottom here. People can't even afford to pay $1 or $2 for their goods and can't fill up their shopping cart. It says here, according to the article, the consumer market is splitting into the luxury segment, which caters to the ultra wealthy and never had it better, especially in Europe, where the luxury index is trading at a record premium to the rest of the market. And then there are the retailers catering to income cohorts, such as Dollar General and Dollar Tree, which are not only getting crushed, they're also getting robbed. They're getting crushed in the stock market, but they're actually getting robbed because people can't afford to spend $1 or $2 on basic goods. This is how bad it's gotten at the lower end. People are suffering. So if we had all this very low unemployment, why would we have this issue? I mean, even people who have low employment, maybe in part-time jobs, couldn't they afford to shop at Dollar Tree and Dollar General? Maybe not. Maybe this is the bottoming out of the lower end of the market, that the poor are so poor that they can't even afford the basics. And this goes along with what I've been talking about for 6 months with rising credit card debt. People are tapped out, period. People, there's no other way to put it. It says here in the article, shares of ultra discounted Dollar Tree plunged on Thursday, tumbling more than 11% after the company trimmed its full year profit forecast after missing quarterly profit estimates, hurt by slowing demand for discretionary items and elevated cost pressures. With stubborn inflation, the company is experiencing a fall in demand for higher margin discretionary goods. Now we're talking higher margin goods at Dollar Tree and Dollar General. How expensive are these? $4 and $5? People can't buy those items. Again, we're not talking about Teslas, BMWs, and high-end expensive items, clothing. We're not talking about that. compared to perishables like snacks and cookies, as dented margin and time and costs have been elevated. And like so many other suffering retailers, according to the article, the company showed an increase in sales, which rose 6.1 to quarter to 7.32 billion. It slashed its profit outlook due to shrink, a polite word for theft. That could be employee shrink or that could be outside shrink. So they do make a little bit of money before the theft, not nearly as much on rising cost pressures. Only a few segments of their stores are doing well, but when you combine the theft, they're going negative. That's not great. Another story here for you. Well, actually, we're going to get straight into gold. That's going to do it for stories for the week. I think those are probably the ones that we needed to talk about. There's actually a lot of other stuff going on, but I'm going to save some of that because it's been a very story-intensive week, and we wanted to get into what's going on in the gold and silver market. So I'm here on gold on the CME Group's website, as you can see, and we're looking at the volume and open interest chart as we do every week. And I'll look at the regular chart here as well in a moment. Then we're going to talk about silver. I like talking about silver, and I've got some silver rounds I want to share with you today. So we can see there's elevated volume at the last part of May, and you can see people are rotating out of May contracts, and they're rotating out of June. As of yesterday, 42,000 contracts rolled out of the June contract in gold and rolled into August. So August is very clearly the big contract month. And this happens as we approach this month. People are going to have expiring contracts. They want to rotate into the futures month. Why? Because it's a futures market. They want to trade the future. They want to bet on gold price in the future. This has nothing to do with physical. This has nothing to do with me walking in and buying one of these. None of these numbers have anything to do with this whatsoever. This and the demand for this has nothing to do with what you see on your screen, ladies and gentlemen. It has nothing. And I just want to reiterate that over and over and over. Sometimes big deliveries on this market can spike rates, but let's look at the trading volume. We had 336 open interest contracts for August and a total of 100 deliveries in the current month. Do the math on that. In fact, let's do that. Let's just do this. Let's just have some fun and say, okay, we had 100 deliveries on volume of 336,000 for a percentage of 2.97 to the -4 decimal places, scientific notation. That's not even 100% were delivered contracts. So let's not make a mistake on what's driving the price here. It's paper trading and it's rolling to another month. And that's what's happening. And you're getting some substantial EFPs. 5,813 gold contracts went over to London because why? Because you didn't have enough contracts in May. It wasn't a big delivery month. You could only deliver the last 100 and 99 moved and one at close. Okay. This adds to 100. And so where are you going to get the rest of your gold? You want to go to COMEX, you got to trade it over to London in terms of taking a COMEX futures contract and trading it over and try to get access to that. That's what those are for. And we see those all the time. It means there is a lack of deliveries in the current month because it wasn't a big delivery month, but it also means that the demand for the physical is risen. The demand for the physical is high, even though these paper trades have very little to do with that. And you can't get it off the COMEX. You got to go to London. This happens and this happens and this happens. Looking at the price details. Now, this is as of 12:45 p.m. Central Time when I started the video today. So it's very recent data. We basically have gold trading up to 1944.30. That's a nice little boost to end the week. Not a big deal. We're going to go over silver here really quickly. Not a lot to talk about. The metals are range trading. So I'm going to give you a shortened version of the normal treatment. Not high volumes in silver. Not a lot of dumping going on. A little bit. 1,035 EFP contracts over to London because they only have 132 open in the current month. It looks like traders are positioning for September to be the next contract month and rotating out of July, but there's still a lot of action in July. So I would say all the July numbers is what's driving the spot price. Has nothing to do with physical delivery at your local bullion dealer or anywhere else that you're going to get it as a retail. And most of the industrial demand is not coming through COMEX right now as well. Either it's going through other places, straight from miners, separate contracts, that type of thing from the refiners. Up 44.5 cents so far on data today. This is Friday's data, so silver's trading up today. Nice to know. Nice little trade up. Here is a chart in which I graphed out some Fibonaccis. I want to talk about this. This is the range trading goal we've had for the last few years. Why? The pandemic. So I wanted to look at gold and silver post-pandemic or post the initial thrust of the pandemic. So we looked at the beginning of 2021 to now. That's a couple of years worth of data. And you can see we've got this big range trade from about 2050. Last gold all-time high, which occurred over here, was like 2074. But 2050 really is a range trade. You can see peaks and peaks supported here, and then the valleys supported here about 1670. So that's your range over the last 2 years of trade. Certainly it dipped back down last year into that 1700 range and come back up. We had a nice bull market here. It topped at the previous all-time high twice, a double top and came back down. This double top testing this channel right here, this double top means you're going to have a negative move down, but it's a temporary move. It's not a long-term move. It's a short double top, meaning the move down is going to be short. That's why we have this fade over here in the gold and silver price. We faded through the 50-day moving average, which is a support line. We have not faded through this darker line, which is 200-day, this squiggly line here. But we have traded back down through some Fibonacci targets, some trading targets. We've traded back down through the 61.8%, and we're testing right now the 50%. This is not a 50% reduction in overall price. It's a 50% in the range that I've graphed out. So the range between 2050 and about 1650, about $400 range that we've been trading in the last 2 years, we're down now about a 50% Fibonacci retracement on that in silver. Now, gold is not doing that. Silver is crashing down, but remember, silver is the yappy dog. It moves more violently. We haven't seen gold move as much. It's still above the 200-day. It hasn't tested this first Fibonacci at 61.8%. It's not retracing. Gold is still strong. It's still in a bull market. It's a minor move. That's why when I look at this chart overall, I don't think gold and silver are crashing down overall. I think it's a minor crash, and I think overall we're going to be okay. And that's the update on gold and silver. I wanted to highlight a silver that I've been given by JM Bullion that I wanted to talk to you about. It's 𝘬𝑀, so you can see that here on the screen. This is a really interesting release where you've got it looks like a bear. It looks like a zombie bear up in a tree, and it's got apocalypse on the backside. Certainly, we've had a lot of talk about what can happen to the apocalypse of the banking system crashing. Not that I think we're going to get to Mad Max, but it's certainly interesting to talk about it. And it's kind of cool. Maybe you want a silver coin sort of commemorating the recent banking collapse and maybe the chance that we almost slid off into a major banking system issue. And you can get these on JM Bullion. Let me show where you can get that by going back to the chart. If you go there, go to JM Bullion and go to silver and go to silver rounds, you'll find the 1 ounce 𝘬𝑀 World Pandemonium Silver, which you can get right here at JM Bullion. I'm holding it up. It's a very beautiful piece. I really love it. If you're interested, go there. We have an affiliate link down below on our channel. If you want to click on that, it just tracks sales. We don't make any money from that, but we do like to track sales. If you guys like JM Bullion as your bullion provider, we certainly like them as well. And guys, that's going to do it for this weekly market wrap up. Hope you guys have a wonderful weekend. Remember, we do this every week where you give you the facts on the market. We tell you the biggest stories. We analyze gold and silver, and we bring you the best news of the week to prepare you for next week and to tell you what happened this week in case you weren't able to pay attention to that news. Stay tuned for more. Next week, we'll be back on a weekly market wrap up. This is Rob Keens with Gold Silver Pros.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.